All right, of course, I'm Yahoo Finance executive editor Brian Sozzi. You take a look at a live shot of the opening bells on Wall Street this Wednesday morning. BlackBerry ringing the bell at the New York Stock Exchange. Yes, folks, they are still around. The company's market cap is $2.2 billion. We're also looking at getting things underway over at the NASDAQ as well. Today of Holes getting poked in the hot tech trade as we still focus on Disney, of course. Advanced Micro Devices, Snap, and Supermicro are all getting hit on less than blowout earnings reports, and blowout is what this FOMO market wanted. If there's any saving grace here, it's that each of these tech stocks are getting dumped for company-specific reasons rather than a fundamental change in the bullish AI thesis. AMD let investors down on the timeline of getting AI chips flowing back into China due to further regulatory scrutiny. Snap had an ad sales glitch in the quarter that led to its latest earnings day fumble, and Supermicro missed estimates and is getting penalized for providing guidance that is silly upbeat in light of the quarterly execution. Now, opening bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all of your money. Bells just rang on Wall Street. Let's head down to the NASDAQ and check in with Yahoo Finance's. We'll check in with Brooke DePalma a little bit later, but we're watching here. Brooke, take us away.
Yeah, what we're seeing is all futures opening, or rather all indices opening higher this morning. NASDAQ about 0.2%, leading the way here as we make our way into today. I also want to take a look at some AI stocks that we've been keeping a close eye on. If you take a look where we are intraday opening here, we do have AMD falling upon that report that they did take a hit from that change up the operating loss when it comes to their AI chips getting banned to China. That operating loss was $155 million in the quarter. That was a hit there, but they did say that they are positive on the Q3 outlook. The AI space is something we're certainly going to keep a close eye on, but once again, all three major indices opening in the green this morning. A bit of a reverse of what we saw yesterday.
All right, thanks so much, Brooke. Really appreciate it. All right, let's turn now to what we're watching here. Number one, are you ready for some football? Disney's earnings beat estimates on the back of a strong show at its parks business, and the direct-to-consumer business led by Disney Plus turned a solid operating profit. But a new deal with the NFL has caught the attention of Disney analysts on Wall Street. Disney has inked a deal with the NFL to acquire the NFL Network and other media assets from the league in exchange for the NFL taking a 10% equity stake in ESPN. Number two, time to hit the pause on the scorching hot tech trade. Earnings out of AMD, Supermicro, and Snap leave the tech bulls wanting more. In some cases, I should say, way more. So is it time to lighten the load on tech following these results, or stay all in? We'll discuss. Number three, the return of stagflation fears in the wake of new manufacturing data this week that showed slowing growth and high prices. The very definition of stagflation. Investors are back to wondering if stocks are overvalued. Stagflation is the last thing the bulls want to witness, with valuations in the market near records and Wall Street banks tripping over themselves to hike S&P 500 targets. My roundtable for today: Globalt Investment Senior Portfolio Manager Keith Buchanan and Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. Keith, I want to go over to you here. We're seeing some weakness right out of the block. AMD, Supermicro, Snap. Anything you think investors should be concerned about in terms of the AI trade off of these results?
Absolutely, and good morning, and thanks for having me. We've looked at this trade and participated for the majority of this big, larger move up to where we are to this point. We're becoming more and more concerned about what we're seeing from a macroeconomic standpoint, whether it's from pressures from the new tariff policy and how it's shifting, corporate America's behavior and reaction to that, and also other softness in the labor and housing markets, and how that's bleeding into valuations. And we just haven't seen the valuations really take into account a lot of really growing concerns we have from a macroeconomic standpoint. And those names that have benefited the most and have reaped the most optimism and had the largest moves and the highest valuation typically are the first ones to really see some of that pressure started to come on their fundamentals as well as their valuations as well. So I think that's what we're seeing from the top of the heap, from the highest value names in the marketplace.
And as if there's any saving grace here for the tech bulls, and certainly they're out there, it's that these are company-specific reasons. Snap has reported consistently poor results quarter after quarter, going on more than a year. AMD, solid quarter, but the guidance a little squishy.
Yeah, and the bar is set very high when it comes to these companies and their reporting and what the stock does around that reporting. I mean, if we take a look at AMD, a lot was baked into the stock already. It is up more than 40% year to date. It has outperformed a lot of the other tech names as well. And the stock more than doubled from its April lows. One analyst saying that China access is really the near-term overhang for the company. So again, the bar set high. And when you see just a little bit of any type of softness, then you're going to see a bit of a reaction with the stock because they have run up so much.
Brooke, how are some of these AI trades taking off here in the early going?
Yeah, in the early innings of trading here, what we're seeing, if you take a look at the YF Interactive, AMD under pressure, down about 5%. We also have Supermicron, another company that also reported down about more than 16%, and that's really leading the laggards here. Snapchat also opening lower, but I do want to take a look year to date because Inez brought up a really great point here. The momentum that we've seen from both AMD and Supermicron as well as Broadcom really has been extraordinary. Year to date, AMD up more than 36%, even before this report up more than 40%, and that really goes to show that some of the expectations here was baked in, and now seeing that operating loss, seeing the Q3, there was high hopes, they beat expectations, but maybe Wall Street just wanted more here. That's also causing it to move lower this morning as well. But if you take a look, NVIDIA not reacting too much off this report, intraday trading about flat. Of course, the AI revolution really being led by NVIDIA here, and that has investors excited as well.
Keith, I'm still locked in on all things Disney. Had a good chat with Disney CFO Hugh Johnson this morning, talking about some of the deals they announced. But going through these numbers, Keith, I see the experiences business, that's their parks business, sales up 8%, operating profits up 13%. I didn't get a sense that the consumer's under pressure and living in a world of stagflation.
Sure, I think the Disney story comes down to the asset they have that kind of holds everything together, and that's live sports. And the deal that they announced this morning, and some rumbles about this yesterday afternoon, has caused some concern among some analysts that the value and the creation of having the live sports as kind of the glue that holds it all together from an entertainment standpoint, perhaps might not have that cachet going forward, and also might not have the pull that it had as it's being leveraged in more creative ways. So I think that's the main concern. I think the parks and the Disney Plus has performed as expected, if not a little bit better. But the live TV concerns are kind of dominating in stock performance today.
And as while Paramount is struggling, trying to close that deal with Skydance, you have Comcast being split up. Warner Brothers Discovery is on its, last legs. I don't think I'd be wrong to call it like that. You have Disney coming out here, sending a real statement, big deal with the NFL, big deal with the WWE. It's almost like Bob Iger is checking a lot of boxes before he hands off the baton to a successor, which is supposed to be announced, if not by the end of the year, at the very latest early next year.
Yeah, Brian, and I was also listening in on that conference call, and Bob Iger was so excited about this NFL deal. He basically was saying that they are going to give ESPN access to more NFL games, that they will have commerce opportunity because of this, because they'll be able to buy NFL merchandise. There's going to be advertising value. So he was really, really bullish, even calling it a sports fan's dream. But I was very impressed also, as you were mentioning, when it comes to cruise ships, experiences, those all came in very strong. I mean, you had Walt Disney World record a third quarter revenue. You had Disneyland Paris that came in strong. They have this Singapore ship that's going to have 7,000 passengers on it, their biggest ship ever. And this jives with what we've been seeing also when it comes to cruises, that this has been a strong quarter for cruises, this strong year for cruises. The cruise lines also talked about this. So when it comes to that sort of experience where passengers can go to many different places in one ship, in one cruise, that's a sort of value proposition for travelers. And that is something that also for those types of consumers that can afford those experiences, it's strong. We've seen something with the consumer where we're looking at the sort of lower income consumer that's having a harder time. But for that higher income consumer, it's still pretty strong.
Inez, you ever wonder how some of these cruise ships actually float? I mean, you're sticking 7,000 people on a giant cruise ship, and in some cases they're like really motels. It's amazing, and then a lot of analysts on the street are in fact very bullish on these cruise experiences. I should note too, Hugh Johnston telling me this new NFL deal, Disney CFO that is, will be 5 cent accretive to its earnings. I thought that was very interesting. But Brooke, Inez brings up a good point on the consumer. Clearly people are taking cruises. Didn't really get a robust read from Marriott when it reported earnings earlier this week. But McDonald's out this morning too. Same-store sales bounced back quarter over quarter.
Yeah, while Marriott said that there was softness in the U.S. consumer demand, what we're seeing here is that, I feel like a broken record, but consumers want the best bang for their buck. And that's why those Disney cruises did well. Like Inez said, you can go all over and go to the most countries. And with McDonald's, what we heard from them is that that $5 meal deal that they introduced last year now has continued into this year, as well as other promotional offerings like buy one, get one, performed well this past quarter for McDonald's, and that actually reversed the same-store sales slump that they've been seeing here in the U.S. to the upside. They saw U.S. same-store sales jump 2.5%, and on the call, the CEO emphasized that value offerings were the name of the game, that low-income consumers are still under pressure, but high-income consumers are willing to spend. We saw average ticket move higher, and we continue to hear about this bifurcated consumer, the low-income consumer clearly under pressure here, where the high-income consumer is still willing to spend a bit. And what we saw during this quarter was that consumers went out for those McCrispy strips. They were willing to lean into the Minecraft promotion. And also, there's lots of optimism about the launch of that snack wrap back on July 10th and what that could mean for Q3. And while they didn't give guidance for the third quarter, they did say that once they lapse that E. coli outbreak that obviously hit sales this time last year and the launch of their meal deal in the fourth quarter, they expect to return to growth ultimately. And so lots of momentum moving in. That $2.99 snack wrap price point, I don't know, Sozzi, if you tried it, but that $2.99 price point is here to stay, and franchisees voted on that as well.
Brooke, I'm not
value
eating
is
that.
key here.
Those snack wraps, they could price them at 50 cents. I'm still not going anywhere. Anything fried from McDonald's, no Big Mac, no nothing. It's just not happening. Keith, I want to go back to you. I'm not going to ask you about snack wraps, but if you want to comment on it, feel free to. Fears of stagflation have returned to the street. Should the market be pricing this in?
At least some semblance of it. We've talked a lot about how tariffs really manifest themselves and where does it get absorbed along the value chain. It is a tax and it is paid somewhere. On the front end, of course, it's paid by importers. But along the chain, pricing power dictates who can pass along what. And what we've seen through this earnings season is some very high-profile announcements of charges because of the new tariffs. But what we're also seeing from the last non-farm labor report that we saw on Friday was, the lever that most corporate America can pull when it comes to, variable expenses, if they have some outlook that's not as optimistic about margins, is to not hire and perhaps even to lay off workers that perhaps were on the cusp of that event anyway. So, non-farm labor report really showed us that tariffs really have an impact on consumer behavior as well as corporate America, as well as how we're looking at going forward. The stagflationary, it either comes at the expense of inflation, upward pressure on inflation, or corporations eat it, which can take away from growth. And both of those combined is a stagflationary environment that all of those in our seats are really concerned about going forward. So that's really one that we're laser focused on making sure that once we start to see signs of this becoming more problematic, then we take the proper action to protect some of our clients' assets. So we're really concerned about that environment. That is not our base case, but we're making sure that if that does come in place, we can take the proper adjustments.
Good point. I'm going to resist my urge to ask Inez her thoughts on the snack wrap. I'll take that offline, as they say in corporate America. A big thank you to my roundtable today: Keith Buchanan, Brooke DePalma, and Inez Ferre. Straight ahead, Rivian stock is looking for a charge after a terrible quarter in outlook. And in our power player block, TD Ameritrade's former CEO Joe Moglia stops by at this key moment for the markets. Don't go anywhere. Welcome back to Opening Bid. Rivian stock is getting short-circuited after another disappointing quarter last night. The company had all the wrong notes again as it solidifies its status as an IPO flop from the 2021 debut class. Rivian reported a bigger than expected operating loss in the quarter and said it would likely generate an even larger operating loss for the full year when it's all said and done. JP Morgan is out today reiterating an underrate rating on the stock, the equivalent of a sell. Even the always bullish Dan Ives at Wedbush is expressing caution on the near-term path forward. Ugly fact on Rivian before I go. Rivian's market cap now stands at about $14.5 billion, down sharply from $86 billion or so when it finished its first day of trading on November 10th, 2021. Ford's market cap is $44 billion, GM's is $50 billion, and Tesla's clocks in at $995 billion. This year has been one for the ages in markets, and we still have 4 months left on the calendar. The fear of missing out on more gains has pushed up valuations on top tech names like Nvidia and Microsoft to ever higher levels. The meme stock trade has returned in force, led by the likes of Opendoor. And companies are using the friendlier crypto backdrop supplied by the Trump administration to diversify their cash holdings into crypto. Joining me now for more on all of this is Joe Moglia, former chairman and CEO of TD Ameritrade and current executive advisor to the president of Coastal Carolina University. Joe, always nice to get some time with you. Appreciate you taking the time. So this fear of missing out in markets, help us understand it and how much longer you think it could go.
Fear of missing out on markets will probably go on for the next decade or so. And it depends on what's going on. When markets are doing well, retail investor feels they got to be involved. And if the market's running, then they feel they got to catch up. Therefore, you got the FOMO issue with regard to what's going on. The issue with that, Brian, is that it's an emotion. It's an emotion. And I think whenever you're dealing with the marketplace, whenever you're looking at your portfolio, when you're looking at the economy, while it may get emotional sometimes, you cannot make decisions emotionally. So you've got to step back a little bit. You've got to take a deep breath, and you've got to go back to what you believe your strategy is, or what your process has been in terms of making decisions. But emotion cannot get in the way. Can't get in the way on the way up. Can't get in the way on the way down. But I do acknowledge that it's part of the market today right now.
Joe, you're on the ground floor of the retail investing movement. I hate when people tell me that the retail investor is unsophisticated. They don't know what they're doing. I've always found a lot of these investors to be very sophisticated and certainly take a lot of pride in what they do. What's your message to these investors that have been trading this market even higher this year, in some cases chasing performance? What should they be doing today?
Yeah. Well, Brian, I think, for the ones that really see in the real world, right, there are many retail investors that are very sophisticated, really know what's going on. Then there are some that really just are not and really don't get in the market too much. They don't worry about it too much. And when they do, it might be an emotional trade. But when you have an understanding in terms of what's going on in the markets, as I said a minute ago, you've got to have a disciplined strategy. So the markets have hit all-time highs. We've come off a bit, but they're still really up there compared to where we were 6-12 months ago. And I think an important part of investing is you've got to be able to trim. When the market's going up, you got to be able to take something off. Like every 10%, something's got to come off the table. Not all of it, unless there's something you don't like anymore. If the reasons why you bought it are still the reasons why you hold it, that's great. But when you've had a nice run, you got to trim some. By the same token, if there were a big correction, things that you like, you should be adding to that. One last point, Brian, and that is, it's a fair argument to say, it's hard to get in now because we're at our highs. That's where I think your dollar cost average. And I don't care if you're an institutional or an individual investor. You trim into strength, you buy on weakness, and you dollar cost average when you want to get involved with something, but it's near its highs.
Joe, I'm sure you've seen some of this action the past week in Opendoor, one of the most active ticker platforms on Yahoo Finance. What do you think about social media driving sentiment and stock price swings at this point?
Well, social media is pretty powerful. You go back to when we had GameStop and the whole meme craze, which exists a little bit today. Now it's not as vigorous as it was a couple of years ago or whenever it was. But I think if you're an individual investor and you follow some of the blogs, right, whomever it might be, and you're part of those respective chat rooms, and something kind of strikes your fancy, even if you don't quite understand exactly why that particular stock is a good buy or not a good buy, you do understand that there are people you like and trust and believe in, even though you may not know them, that are getting involved. So you tend to get involved. Now, once you do that, I would say the exact same thing I said a minute ago. You can't get in, buy something at 5, and then it starts to go to 10, 15, 20, 25, 30, 35, 45, just keeps going, and you just sit there and not do anything about it. You got to start to trim. If it's 40, 50, and 2 days ago it was 5, you got to be really careful about whether or not you're going to get involved with the market. So what the typical meme trader doesn't have is risk management tools. If they had more risk management tools, they had a better understanding of just what we talked about, they might do very well in something like that. But the key in the meme craze is not to blow up and not to get burned. Not
good when you blow up. Joe, you're focusing now. You're spending a lot of time in the Ethereum space. Take us through this new initiative for you and why it's important that you've put your name to it.
Well, our deal is FG Nexus, Fundamental Global Nexus. And I think when you think about, we kind of look at the world the way it is today, Brian, but the reality is blockchain is going to change everything. 5 years from now, the markets, settlement, stocks, bonds, options, no matter what it is, are going to be driven by what's going on with blockchain and Ethereum or something like Ethereum. Right now, Ethereum, with regards to the blockchain and transactions, is the biggest that there is. Secretary Bessent said a little while ago that I think it was stable coins. A few years ago, we never heard of them. Today, the market's 250 billion, but he says by 2008 we're going to have 2 trillion. Now, Ethereum is 55% of the stablecoin market and the token market. So as we grow and grow and grow and grow, and we move more toward blockchain, Ethereum, blockchain, Bitcoin, etc., this market is getting bigger and bigger and bigger, and it's going to take over what exists today. A little bit more so, but a little bit like the craze that took place in the 90s when everything had to be done by auction, by voice, and then all of a sudden electronic trading came in because of the internet. This is going to be a much bigger jump than that. So things that take 2 or 3 days to settle will happen instantaneously. You're able to get things validated, and then the company that has that and stakes it stakes the Ethereum so they can develop a higher yield on it. If they're doing it right, and I feel really good about our management team, there's no reason why that the stock itself or the company itself should outperform the Ethereum or outperform the cryptocurrency as time goes on. And so I think long term, it's a really, really good play. I think that the bet is that an individual company with proven digital asset management that knows what they're doing can do well enough where they can continue to grow and add to their position. And at the end of the day, the individual investor or the institutional investor wind up doing really, really well.
All right, well, good luck on the new venture. And of course, there is more out there in the world than cash. There's crypto. Joe Moglia, always good to see you. We'll talk to you soon.
Take care, Brian. Thank you.
All right, coming up, yours truly and Julie Hyman will drill more into Disney's earnings and share more perspective on my chat with Disney CFO Hugh Johnston.